the entrepreneur stages and stuff like that.
All right.
And we've been doing our we have
We've been promotion.
All right. So if there's nobody, then we were talking to ourselves, lah.
Yes.
No, there'll be someone.
So
Okay.
Hi, Mom.
The comments are here.
all right, the comments are there,
Any
but
questions?
nobody is around yet now. Am I right? Is there anybody? How would I know?
Yeah, how
Yes,
do we know?
we are live. See that?
I know, but how do I know someone is? Okay. All right.
We are live.
Okay, we are live now. All right. So it's kind of weird now when you're not so sure whether someone is actually watching you or not.
Yeah, but you can bet your mother is watching.
I can bet someone is watching this. Anyway, we are live now on Atta, Ask Atta. All right. Ask Atta is actually a live program whereby is a live Facebook program whereby we are open up to everyone to be able to ask any form of question, any sort of questions. And
To Atta.
to Atta. But this time around, we have a special guest, someone next to me who I know for almost 40 years now, eh?
That long? I thought it was just like another 5 years ago.
Yeah, 40
Yeah,
years.
we've gone a long way.
We got a long way,
Yeah.
40 years. We were in the same school. I was his senior for 10 years.
Yes, you can see that.
Okay. Anyway, it's good to have you.
Thank you.
Yep.
Thank you for having me. here.
Right, and Jamaludin Bujang, marked his fame in the venture capital market and known much better as JB. So I call you JB. Of course, you are known someone else when you were in school,
Yeah,
which
yeah,
I
yeah.
will not mention.
The bachelor guy.
Which I will not mention. we are like what I call animal farm, in the
Yeah.
school
Oh,
those
yeah,
days.
yeah,
Right,
yes.
right. Tell me about it. Anyway, so that will be to start with. So the topic this time around will be on valuation. It is very interesting. Anyway, if any one of you are on live now, you can ask any question. You just put it on the comment box there. There's a question, and we'll answer you. I'll get actually JB to answer you, as much as possible. If you missed out somehow, you'll be able to actually watch it again, live on our Facebook, right, and so on. Anyway, the topic this time around will be on valuation. It's a very interesting topic. In fact, sometimes I would say is a very depressing and challenging topic as well, that especially venture capital like JB has to face, day in, day out as well, every time when facing companies who would like to fundraise as well. So I guess, as you know, for us, Atta Plus, we do receive a lot of issuers who would want to raise funds, and every time, the pressing question is always about valuation. How do you value your company? We have companies that come to us, coming up with a value which sometimes will be a bit surprising, too low, but most of the time will be, I would say, a bit too high. Yeah, a bit too high. Again, of course, as Atta Plus, we will try to guide them as much as possible in terms of how do you value, and give them some form of what I call it examples, I guess. For example, in the stock market, we do receive scenarios whereby people value the company at 30-50 million ringgit, and a simple question that I ask them, where do you get a number from? Of course, most of the time they would actually compare themselves with a company which is perhaps already listed in the Nasdaq, and so on. So typically, I will always ask them, let's go back to history. If you compare yourself with Facebook, Google, you must go back to the history when they were like Facebook, when they were in school. When they started in the university, right? Same thing with the rest of the other well-known brand in the internet. You can't actually compare them now as it is. That's one. Number two, I always also say that let's look. Even in Bursa Malaysia today, they probably about 30-40% of the companies which are valued much lower than like 50 million and so on. And these are companies with traction, with track records and so on. And all right, JB. So I guess I'll get you to perhaps give some brief of what you think about valuation and what sort of valuations. Anything you want to talk about?
Right.
Okay. So that perhaps we can start some question from the audience.
Okay, I think I'll just begin with what's the topic today. The topic is essentially whether it's an art or is it science.
Science, yeah.
Right? I think if you want to be very strict about it, everything got science behind it, right? Everything can be explained in any field, even this one in finance. But of course, if you look at the life cycle of a company, company is starting and then you got company growing, after that you become mature and all that, right? So that's one life cycle. And companies that has grown to mature, they become mature. It's a lot easier because it's a lot easier to value because we have a track record, people understand the business, and then your earnings, your market is established, your earnings pretty much predictable. And it's a lot easier to value those sort of companies than companies that are very young, right? For most of you, it's startup companies. So there's a lot of established signs to value mature companies. The easiest one would be, you can use benchmarking with other companies. If you're a stock market, you know what's the times, the number of PE you can apply to your earnings. Or you can use discounted cash flow. That's probably the best way to value companies. And for earlier stage companies, of course, it's a bit more tricky. There's still science to it, but a lot of it there's art as well in there. And it comes to art, it's a lot about comparing, or there's a lot of, I wouldn't say a fudge factor. It's a factor that you have to be comfortable with. And there are two sides here. First, on the issuer and also the investor, right? There are two sides, and that numbers, the gap between what the first person has and the second one can be quite wide.
Right.
So you have to agree to some number in between, and then only after that the transaction can happen, the funding can happen. So, but I must say that I've been in the industry for at least 15 years, doing VC. It's very, very tricky to value startup companies. I was in my first 6-7 years in doing VC. I was in biotech fund. It's even more trickier. There's a lot of the product and the science behind it. Come up with a product is actually a very long gestation period in biotech, and a lot of things can go wrong. Right? Now, since then, I'm in the tech space. Probably it's a lot easier to evaluate them. But the principle is the same. There's still a lot of art in valuing the companies. Now, I've been asked this a lot of time, and how you guys come up with valuation. I think forget about the numbers first. I think a lot of startup companies being evaluated first, of course, on the product, right? And if you're a technology company, we want to see whether your product, your company's your technology is disruptive enough. Of course, it has to be disruptive. If you 5-10 years ago, if you come up with a technology product, chances are it's very disruptive because no other people is doing that. And now 10 years after, probably your product is just like me too kind of product, right? So again, if you have to be very innovative in coming up product and how you're gonna capture the market and all that. So that's the first thing. Secondly, we are evaluating on the execution part of it. Whether you have a team, you have a founder that can execute that plan and can grow the company, raise funding even. And thirdly, you want to see whether the product or technology is scalable. Now, some products have more. It's not easy to scale. If you're investing for example, in a factory producing widgets, and for you to expand, you have to adding fresh capital all the time, compared to product that you come up, as an ad or as an, number crunching, analytics, for example.
Right.
Acquiring new raw material, in this case, data, is not as expensive as building a factory, and stuff like that. So the second example is very, very scalable. So we want to see scalability as well. And fourthly, you want to see whether, as an investor, and this is very important, I think a lot of people forget about this. We want to invest in a company which we can also exit, right? Because we are not a founder, we are a financial investor, and I get money from other people too. So I have to return their money. Of course, I have to return the money with profit. If I cannot promise a profit, they're not going to give me money.
Right.
If I don't get money, you don't get money, right? So we want to see whether that company, the company that we invest, we can exit, right? And how we know the company can exit? We want to know whether your product is actually, it's your company can be acquired or by another companies as a way for us to exit, or can be IPO'd after a certain time. And I also mentioned earlier about fundraising, the ability for the founders to raise capital. So we don't want founders where you can just raise once and that's it. After that, you cannot. We've come across so many of them here.
Right.
They're good at raising the first round. After that, they find it very difficult to raise money on the next round. So there are only a few. I would say not more than 10% of the. I want to be very frank here. Not many founders are good at fundraising. So these are things that, if you're a founder, you must be able to raise money, for your company. And finally, valuation. Okay, that's why we're here today.
Yep.
So your valuation has to be right. After doing all that, whether you can see your product disruptive, whether you have a team that can execute, whether you can scale up and all that, and you must come to a valuation which the funder has to agree. Otherwise, you cannot get funded. So I think Aimi just mentioned, some lately, especially, I think the last 3 or 4 years, valuation has gone up tremendously. I think this is discussed not just here, but everywhere, even in the West. Talking when is this overvaluation? Is it going to stop? Is it going to increase, or is it going to crash? So this has been discussed, 4 or 5 years ago already.
Right.
It hasn't so far, but you can bet eventually that will come when the situation doesn't warrant it anymore. So you have to be careful. Now, as an investor, you don't want to invest company, you don't want to overvalue the company, and then you invest and suddenly you get caught.
Yeah.
Right? You have to exit at lower valuation. So, financial investor like us,
Is it higher even?
Sorry?
Is it higher?
Yeah, it's always we want to exit higher. I mean, of course, the founder want to exit at higher price as well.
Sure.
So you don't want to value your company wrongly from the very beginning. Now, the best ways is actually, raise a small amount first. A lot of companies, when they come to us and they say, hey, look, I need 5 million, I need 10 million because I want to do this and that, so I don't have to raise money for the next 3 or 4 years. That can be very difficult to the VC to invest, because even if we agree with your business model and we know we can see the path very clearly, we don't want to give one chunk of money which can cover you for the next 4 years. We want to give you 1 million first, even if, let's say, I've allocated 4 million for the company, right? I'm not going to give you 4 million straight away. I'm going to give you 1 million first. Once we have reached a certain milestone, right? You have delivered that. I'm confident that you can do. Then I'll give another 1 million, for example. I'll give another 1 million after that, or I can give you 2, and then I'll give you another 2 after that. So it'll always been like that. It's actually a good discipline for the company. It's good for the investor as well, because now they know that the founders can work towards meeting a milestone that is being imposed on them. So basically that's how funding works, coming from VC. Yeah, that's what it is.
Right. Okay, thank you. That's a very very comprehensive explanation. For you who just came in, we are just over 15 minutes from we started just now. This is Ask Atta. It's a FB Live, where we allow anyone, out there to be able to ask questions to us, especially with our special guest today, Mr. Jamaludin Bujang, better known as JB in the market. He's a managing partners of Gobi Partners, all right? Okay, so there are a few things that was mentioned earlier in relation to how typically a VC who want to actually invest. I think there are quite a number of things that he mentioned. Number one, how disruptive. We are here talking about technology-based company. How disruptive are the technology? Which I would like to actually touch a bit more on that one later on. The execution team and how they manage to be able to raise more fund later on. The scalability of the technology itself, and the fact that also whether how the venture capital will be able to exit, in the future, whether through IPOs or trade sales and so on. Yeah. And of course, the most what we call challenging part of any of this exercise would be the valuation. Yeah. And I think this is what was mentioned earlier. I think Mr. JB also mentioned just now that what would be good is that if we can actually raise small amount first, and actually raise more in the future. Okay, so I just want to touch a bit more. I mean, talking about valuation here, right? There are lots of, I mean, if you go to the textbooks, there are lots of various way of how people actually, companies actually being valued, right? Mm-hmm. And I think typically, in Malaysia, there are probably 2 or 3 types of how valuation have been made. Right. Like the typical one would be PE multiple, and then you're talking about DCF and the discounted cash flow. Right. NTA, of course, the most safest one, but right. I guess that tech company has no NTA, no assets typically, right? Or no tangible assets, no tangible assets, right? So I guess perhaps you want to elaborate a bit more on this.
Yeah. You're right. Normally, startup companies, especially tech companies, right? There's no tangible assets. A lot of it because it all started from ideas and what you learn and all that. You may be able to IP some of your ideas, but chances are you don't do that because it takes a lot of money and time, and technology moves so fast, and within 6 months, if you don't do anything, your technology got obliterated. It's no longer relevant until you innovate your technology every 6 months. Now, you don't have assets, you don't have cash flow, right? You have ideas. So how on this side, VC, right? So how then do I value you, especially when you have no track record, you have no revenue. Right. Ideas. Yes, you have a marketing team, but you haven't secured any sales yet. So now the VC will have to ask, okay, wait a minute. I kind of like the idea because I've seen some companies doing about the same thing back in other countries, and they've done it. They've done very well, and the reason why they've done very, very well is because the product is relevant to that specific market that you're targeting. And here we have the same guy trying to do the same thing. So I think this thing can work. Now we have established a fact that it's something that is investable. So how do we value this thing now? Now the problem with a lot of founders will without any specific method, they will just say, okay, since I need 3 million because I want a building for 1 million, I'll pay my salary and my team another 1 million, I need other things for 1 million, so I want to raise 3 million. Okay, and then how much can I give?
10%.
Maybe I just give 10%.
That's how the 30 million comes in.
So suddenly you didn't realize that you are valuing your company at 30 million.
Right.
Now on the VC side, right? And suddenly we have someone come with a proposal. We kind of like the business already,
right?
And then we want to put money, but we are ready to give you 3 million. But then again, I only get 10%. So I don't think you're worth 30 million, at least not now anyway, right? You may be worth 30 million in 3 years' time or 5 years' time, but you're not going to worth 30 million now. So what do we do? So that's why I said earlier, you have to raise a smaller amount first, so you can afford to have a lower valuation to attract capital to come into the company, right? But at the end of the day, your valuation has to be realistic to both, to the funder, to the VC. So in this case, the VC will look at your business case and they compare with that company that they're referring to.
Sorry.
Sorry.
Yes, there's someone coming.
Oh, okay.
Anyway.
Okay. Let me just finish this.
Yeah,
so, after we look at the numbers and we say, hey, wait a minute, you're not worth 30 million. I give you 3 million, but you have to give me, let's say, 40% or 50% or 60% because that's the valuation of that's my valuation. You want to take it or you don't? So again, that's where the negotiations start to come in, and eventually both parties has to agree to that sort of valuation. Okay, we have one question.
Right. We have one question by Mr. Khana. What valuation means for the issuer, and what does it mean to the investor? Okay, I think you just mentioned that.
Yeah, maybe I can just expand this a bit. You want to raise, of course, on one side, you want to raise money because you want to expand, you want to grow your company. But on the other side, to the investor, it's about what do I get back? What do I get back in return? Right.
There must be always an upside somehow, right?
You're buying a car, for example, right? You want to buy a car. You have 100,000, but you want to buy a Mercedes, for example, right? Is market value of Mercedes brand new at 50,000?
Right.
Maybe not, but if you have 50,000, you actually can buy maybe a Myvi, for example. It's the same thing. So you cannot valuing a company at Mercedes when your car is actually a Myvi. Okay, now I'm just giving an example. Both cars are good. I've used them both, but it has to be reasonable. So again, don't overvalue yourself. I've come across a few examples before. There's one specific example we come across. I think about 3 years ago. This person get a term sheet from one potential investor, and then they're valuing a company, and then this guy come and show it to me, and in my mind I thought the valuation was pretty rich. He's valuing company quite highly, so because personally I wouldn't invest in at that valuation myself at that time. But I did tell him that if you want to take this funding, which is good for you, but you must be ready to, if you don't deliver the numbers, if you don't deliver the performance, you might find it difficult to raise the next round.
Right.
And what happened was that after 3 years, he found it difficult to raise money because he couldn't deliver the metrics. So you have to be careful.
Right. All right. Okay. Very good. Just to touch some of the things that you mentioned just now. Okay, you mentioned that sometimes when people come to you and ask for high valuation, is there another way of doing this by structuring it in such a manner that it is not purely shares? It could be a quasi equity or something like that with preference shares or something along that line.
Yeah, it's always on a preference shares basis because we always treat that as an equity investment. That investment, the instrument that we receive, always preference shares, is convertible into ordinary shares eventually. But we always treat it as equity investment.
Right.
I just remembered. I didn't touch on this on the valuation method. Normally when you evaluate the company, if you're a stable company, you want to use a DCF, PE, and all that. But if you have nothing to show, maybe you have a revenue, then we can use revenue as a rough guide for valuation. I've just checked with listed companies. I just got some numbers yesterday. We're just looking at listed companies whose valuation is more than 1 billion US. Apparently in Bursa now there's about almost 60 companies with valuation more than 4 billion.
Right.
And their valuation compared to the sales, compared to the revenue that they have, is actually about 2 times. So roughly you
Okay.
can use, So if your company is
Okay.
making 1 million, just your valuation is about 2 million. Of course, it's a bit unrealistic in today's
Right.
sense, but
Mm.
because your growth is different than those companies,
Sure.
right?
Yeah.
So your valuation may be not 2 million, could be 4 million,
4 million,
you know, 5 million, depending on how fast you grow.
Right.
So, but that is sort of the benchmark that you can use. Yeah.
All right. Good. I mean, we have a question here from Eric. Sorry, my eyes. Eric Morgan. All right.
Morgan.
Morgan. All right. Thanks, Eric. Welcome to Atta Us. Your question is: can you expand on how you view disruption as an indicator for success? Is it better to be something very new, different, but then potentially require a change of customer behavior or mindset, or something that improves significantly on already existing solution, but then risks being seen as just what do you call that? A me too.
Yeah. It's I think one thing you want to avoid is a me too kind of.
Right.
I mean, if you have a solution on existing technology, for example, but you have a better way of reaching to your customers, so your UI UX is better than the rest. Somehow make it easier for people to use your app to make an order, for example, compared to other app. That is actually innovation which can set you apart, you know, compared to others. That is disruptive.
Right.
Of course, like 10 years ago, 7 years ago, you know, people couldn't imagine that you can get a taxi by just booking from an app.
Right.
That was very disruptive. And now we can see the results of that, right? Now you don't even get a taxi, you can get a private car and pay online even, right? Make it easier. That was very, very disruptive. But now, of course, there's just so many companies around. You have to be a bit more creative on that part.
Right.
But so long as it's not a me too kind of product, with very little differences in terms of innovation compared to your nearest competitor, I think that's probably very, very risky for you to do.
All right. Okay. I like this part of disruptive because I've gone through some of this experience myself. Because I think disruption or disruptive technology or way of doing things as well, at the end of the day, is quite in the hands of the beholder, in the sense that, okay, I'll just give you one example, right? This was probably in year 2000, before the year.
Just 20 years ago.
That was 20 years ago. Yes.
Man, you old.
I'm as old as you are. Okay. I think about sometime around. There was time when was MathCap started? I think
it's about 2001.
Yeah, around.
Yeah, it's about 20 years ago. Yeah,
about that. All right. This is just after MathCap. I remember I posed this question to some guys.
Right.
In the MathCap itself.
Okay.
Before,
I wasn't around that time. It's
time.
not me.
Before that time, all right.
Okay.
I was in a seminar. I was giving a talk actually, and MathCap was one of the audience at the time.
Okay.
I remember, yeah. And they were talking about again valuation and so on. Now, at that point in time, Google just started. All right, just started about 2005,
I think.
No,
three.
Two or three. They were just a one page.
White.
Right.
Is in
Hi Zulaika, Zainudin. I'll get to you. I saw there's questions from you, but I'll just go through this disruptive because it's quite interesting. You guys see it. What happens that as you know, before Google there was already Yahoo. All right. Okay.
Alta Vista.
Okay. Yes, remember those. Hotbot, Alta Vista, and many more. All right. And most of them are no more.
Okay.
All right. So anyway. You have Yahoo, although Yahoo is still around.
Right.
I remember in those days, anyone who said that, I'm going to do a search engine, I'm doing directory services, someone would just say, I think you're crazy or it's a madness.
Right.
Yahoo is already a multi-billion-dollar company, valued at that point in time,
Right.
And if you want to enter into that, it's almost ridiculous.
Mm-hmm.
Today, sad to say, Yahoo is in the Malay pepatah, we call it, hidup segan mati tak mau.
Okay.
All right. And where Google has gone from just one page of nothing, just a search box at that point in time, today as what it is.
Yes.
Multi-billion, innovation, innovative, more things to come.
Right.
And I asked the same question to this guy, I wouldn't want to mention the name.
Who was MAFCAP before?
It was MAFCAP before that. Yeah, I wouldn't want. So I asked him, had Google come to MAFCAP at this point in time, would you invest?
Wow. With
Okay.
the benefit of hindsight, of course.
Yeah, of course, not his
No.
answers.
Yeah,
His
yeah.
answer was
Okay, what is it?
no,
Why?
because there was Yahoo. So,
Okay.
so this is a Me Too thing, right?
Right. Me too thing, yeah.
Okay. So I said, okay, right. So obviously he was wrong.
Okay.
So I mean, again, it's an art itself.
Okay.
This is the point I'm trying to say. Nobody would say who's right, who's wrong, or
Yeah.
else if everybody is right, then everybody become very rich, at the same time. Yeah, you want that?
I think that thinking, I just want to touch on Google and Yahoo and all that.
Right.
I think that person that you asked, maybe he's just looking at Yahoo as a place where you can get information. Not so much on search. He cares more
Content.
about the information that you can get from there. And Yahoo at that time was the browser. It's a browser actually, right? Not so much on anything else.
Yeah.
But Google coming slightly different. It's all about search.
Pure
right?
search.
And
At that point in time, pure search.
and the founders of Google they're mathematicians, right? And
Yeah.
it's all about crunching numbers and all that, and that's what they do best. It's not about creating or aggregating content
Content,
as their main idea to make
But that's what
money.
they're doing now.
Yeah, exactly. Yeah, but they started off the right track. That's what I'm trying to say.
Right.
So, search is our life is about search. Search of food, search of your partner, search of everything, right? So we have at any one time we always been searching, right? If that guy had realized that this whole world life is actually about search, he would have invested in Google, I'm sure.
Right.
Not about information,
Yeah.
not about aggregating, learning who's gonna win
Right.
football,
Yeah.
who won football last night, what's the weather gonna be tomorrow, and all that.
Yeah.
That is secondary, I think.
At that point in time, you're right,
Yes.
because I guess the most important thing at that point, because there are lots of information out there, compared to now, of course, there are more now. I guess at that point in time, the value proposition that Google put on the table at the time was purely search. They're not talking about even directory services. They're not even talking about anything else.
Yeah.
Just say that we can do search in less than
Yes.
0. some second,
Yes.
which is very true.
Yeah.
Those days,
And
you
more
just-
accurate.
and more
And
accurate.
more accurate.
Exactly. You just do a search on Google, you get the best result,
Yeah.
and very, very super fast
Right.
compared to you go to Yahoo, Hotbot, or
Yeah.
Alta Vista for that
Yeah.
matter. Anyway, now let's go to the questions. Zuleika, thank you very much for coming. Anyway, before I go that, just for those who are just tune in, this Ask Atta is a live FB program which we host. We allow people to ask questions as much as possible, and of course we have a specific topic. And this week's topic is valuation, and we have a special guest, Mr. Jamaludin Bujang, also known as JB in the market. He's a managing partner of Gobi Partners International. Okay, let's see the question. Zuleika was asking, what is the best valuation method for a pre-revenue company? This was answered, but I guess it's all right to go through again. Yeah.
Yeah, and then when you first started, there's no way we can predict how much profit you're going to make, right? You're probably not going to make profit for the first 5 years. So as an investor, we already accepted that fact. Of course, if we can make profit earlier, that's all the better, because profit is the best indication of
Performance.
Performance. How you manage your company, manage your costs, and how well you scale up. Other than that, probably the earliest way, the first thing that will come to your company is actually revenue. So again, revenue is definitely one of the things that we look into, or your potential revenue. That is why if you're a founder, when you first started, your projections is very, very important, because all your assumptions in your projections, say you do a projection of 3 years or 5 years, for example, will be tested by the VC. So how come you're assuming this your price? How come you assume this number of customers that you can get? And you can't be tested all the way through. So we want to get some comfort on whether those numbers are achievable or not.
Right.
Not because we don't trust you,
Yeah.
but you may be a bit too aggressive. We want to see that, or maybe too conservative. But Yeah, we use revenue mostly in the beginning.
Right. Okay. Cool. Okay, I just want to touch a bit more on what you mentioned earlier, about raising small money earlier, and as you go on, get more fund. I mean, I guess the issue that normally people would be facing when it comes to raising small and later is actually the mindset. Against the mindset, right? Is the dilution effect of this. I go now lower valuation, I have to be diluted a bit more, even for a small amount, and then later on I have to be diluted further. Is there any form of mechanism that a typical VC would actually have to be able to address this sort of mindset, or the fact that founders would find that after 3 rounds that I'll be probably left with 20%, right?
Okay. Yeah. Very interesting, because I just had a meeting just before this event with one of our companies, and that person found out that the person started off with 60% in the company.
Right. Okay.
And that was about three years ago.
Okay.
And after money that that has been injected into the company, and that person sells some of the his own shares, they just found out that the person just found out that he has slightly more than 30% in the company.
Okay.
So that's quite worrying. Definitely, the person was concerned about it, and we were a bit concerned as well. I mean, not that we don't aware, but we were surprised that the person just aware about it.
Okay.
No, the thing is, all founders must be ready for dilution.
Of course. Yeah.
Simple, because you take money from other people. But if you don't put money, then you get diluted.
Right.
I was, I told you earlier, when I was doing investment in the biotech space, that is actually even worse. Founders, is very, very normal for founders to, at the very start, they have it's like a single digit shareholding of the company. And that is just very normal. The reason is because if you buy tech, you raise no less than 10 million, even for the very first round.
Right.
If you're tech companies that you are, what we're investing now, but be not as much. So you don't get diluted very much. But bottom line is, you must be prepared for dilution. That is why I think it is best, like you mentioned earlier, raise a small amount first. You get diluted, not a big amount, and then you raise the next round at a higher valuation, so that will insulate yourself from getting diluted one-off in one big jump from the very beginning.
Right.
And then you go up, the valuation go up, company perform, valuation goes up, then you raise more shares. I think that's probably the best way to reduce dilution. Now, I think a lot of founders will forget that for VC, right? One of the ways for us to exit is by redeeming our shares into the company, assuming the company has a lot of money. Now, let's say it's just you and VC as an investor, right? And after 5 years, for example, the VC want to exit, and somehow the company has the money to accept that redemption.
Right.
So when we redeem that, our investment in your company, we take money from the company, right? And your shareholding is back to 100%. So you don't have to worry about dilution.
Right.
Of course, we can sell our share to a third party, then you have to worry about having a new partner that you have to work with and all that. But, dilution is not necessarily bad for the investors unless we are very, very greedy.
Right. So
that is a problem. I think there's a lot of problem now.
Which part? The greedy part?
Yeah, the greedy part. Yeah,
both sides, right?
Yeah. I mean, for VC, we have to make money. There's no doubt.
Typically, for VC like you, I mean, what is your typical tenure? I mean, 5 years, 7 years?
Yeah, normally we want to keep between 3 to 5 years on average. Some has gone slightly more than 5 years, especially when you invest at the beginning of your fund life. That sort of range.
And how many X?
if you set up a fund and you have promised certain return to investors, and normally this return has to be higher than your LPs can make from the public market, right? And if you look at the public market, the typical return is about anywhere between 10 to up to 25% IRR, right? So if I take money from you and I want to keep the money for 10 years, if you give me 1 million and I impute a 25% IRR, for example, so you can calculate from there. So at 25% IRR, 1 million, I may have returned back to you, let's give a number, let's 7 million or 8 million.
Right.
So, but you must also remember, I'm building a portfolio here. Some investment, not all investment will do well.
Right.
Some will go bad. Some just perform just like that. And I have to cover back, in terms of valuation, in terms of value of the portfolio by the one that do well, right?
Yeah.
And yet I still have to deliver return back 6 to 7 million as a target, right? So, that's sort of
all right.
That's what we do.
Very good. Thank you very much. We are actually already almost 45 minutes.
Really? That's fast.
Time flies. Yeah. So we probably can actually set another couple of questions, or one or two questions if there is any. If there is so far, no more. Okay. So far, no more questions.
They're out for lunch now.
Yeah, people are out for lunch now. So it was very interesting. Just to recap some of the things that JB was saying earlier about method of valuation. He touches that. For those who just come in, you can actually have a look at the live, recording live on Ata Plus FB. Whenever you're free, and go through some of the things that we have mentioned. Pretty interesting topics. So we have touched about valuation. We have touched about, let me see, there's another question from Zulaika. Okay. Oh, thank you very much. Zulaika just said, thank you for asking more on my question just now. I'm curious, is there any minimum amount or maximum of valuation for a company?
No.
Okay.
There's no minimum, there's no maximum. It all depends on where the situation of the company at that point in time.
Yeah.
It's easy. Grab, for example, when it first started off, they're not valued at 16, 20 billion, right? Back then.
Yeah.
It was lower, much lower, but now they've come to 16 or 20 billion valuation. So it goes as you grow. In fact, as an investor, that's why you want to see your value grow. Whenever I put money into your company, I want the value of the company to grow.
They are still not making profit, right?
I don't think so, but that's quite a strategy.
Right.
I think companies like that can make profit. They want to, but the strategy is actually to grow as fast as you can, to scale up, wider as much as you can, rather than worrying about the profit first. But you'll come to a time where you have to show profit eventually, especially when you go for IPO. Then the market will say, hey, you cannot keep spending, spending money and without having profit, because I want to see dividend, right? So you have to make dividend. Yeah.
Oh, we got another question. Perhaps this will be the last question as well before we end this live. Oh, okay. We have another. Okay, we can accept another two questions from Eric. If you have a before that, welcome Fu Chiju. I think you got. Probably I just answered the earlier question from Eric first. If you have a company, a solution similar to an existing provider, this is probably similar like what Yahoo and Google is, right? But better. Okay. Would you consider a strategy
brute force
it via superior marketing spend? Example, Grab versus Uber.
You can. As long as it's justified. Look, some people spend on marketing. Customer acquisition can be very, very expensive. So you have to be very careful. You'll have to check. You do have enough calculation to justify the lifetime value of your customer. That's what you need to do first. Okay. You can spend, spend, but make sure that the return on that expenses will come back to you.
All right. Thank you very much. Fu Chinjun. Okay. This is a question. Okay. May I know how can I learn to have venture capitalist mindset? Are you looking for a job? So anyway,
Good.
yeah. And the second question, that especially it comes to evaluation. I guess he's looking for a job. No, sorry.
Yeah, valuation, like I said, I think from the very beginning, we said it can be a very tricky thing. It's part science, part art. Certain life cycle is more art than science, but the other life cycle is actually more science than art. If you had a background in investment banking, Aimi and myself came from investment banking, same bank.
Yeah. Actually, I was earlier.
Just slightly late. You have a good training there if you work in a bank, investment bank, but then you are focusing more on the public market. When I started off doing this, I was back in 89,
Right.
1990, 1991. So I have quite a number of years built up in the valuation. But but that's on public market. But when I moved to the private market like this,
Right.
it's actually quite different. You have to change your mindset that there's not much benchmark they can use.
Yeah.
That's the biggest problem. When I was in an investment bank, it's a lot easier for me to get benchmarking because it's public market, and public market is not only here in Malaysia but also in overseas, which I can use. But
Right.
for private companies, getting the data also more difficult. So it's a bit more tricky to be in this VC space compared to investment.
Yeah. I guess it takes a lot of experience as well. It's not something that you can actually get so-called wisdom or be able to do venture capital, just out of university. I guess you need a lot more than that. Because I think, as you said correctly, also, there's quite a number of art involved, and negotiation as well. I believe, especially when someone comes to you, with something just to give you some example. We do have cases whereby we know that the valuation is a bit ridiculous, and you come with some number. You see, when you do negotiation, sometimes it is good that you come with a number that at the end of the day, the other party will be able to come back to you and counter propose. Right?
Yeah, your job is to convince the other guy, hey, this is my number actually.
When the number is too high, then the other party
even harder to convince, right?
Even hard to actually counter propose. It's just like when you try to sell a phone, and which everybody knows at the end of the day will probably cost about 3,000 to 4,000, for example, and someone tells you that I'm going to sell you at 20,000 ringgit.
Right.
So for you to nego from 20 to 3, that's a bit ridiculous, right? But from 4 to 3 to 2, maybe it's something much more realistic.
Yeah.
All right. So I guess we are almost at the end, of our day. So thank you very much for all of you who has been around with us. Thank you very much. I hope you have benefited from this live session. And if you can, you can share this, with some of your friends later, and this can be actually be viewed as well on Ata Plus Facebook page. With that, thank you very much, and thank you again.
Thank you, Ata
for
Plus
all your trouble, for coming and for being our guest today. With that, we end our live video. Thank you.
Thank you.
How do I do this?
There's a red button.
Yeah.